Hey, this is take 1057.
We were very close to turning it into the Salma show like 2 minutes ago, so I'm glad that didn't work out.
I mean, I've never, as I told you, never experienced this before. We've been doing it for, even before the pandemic, we started in the winter to do these live videos to bring content to our audience, and never had an issue broadcasting. I mean, I pay the pro version. I don't know why. Maybe they have broken relationships with Facebook now, or I don't know. Just like Kanye just lost his contract with some
with Adidas
individuals or ideas. But anyhow, not to go into that. Let's just talk about today's episode. But before that, I would like to introduce you and our episodes and our series. So for those who will be watching this video for the first time, my name is Ainhoa Garcia. I am a realtor with Realty of Chicago, and I've been doing these videos for a while. This is the fall and winter series of episodes about housing market in the Chicagoland area. And we had our episode episode one last week about how is the market and what's really happening in this shift in market in the Chicagoland area. By Chicagoland, we serve all the city. We have a big team, and also suburbs. So if you are thinking of referring any business outside, we also serve suburbs. And I just wanted to continue bringing good information. As these professionals, we have to. It's our obligation to educate our communities, especially because during time of recessions and adjustment of the marketplace, usually the communities that we serve, they are the ones that suffer the most. So time is very crucial that we bring the tools and resources, and that's also why we're doing episode 2, and it is about getting pre-approved, and that's why we have Salma Manaa with Fairway Mortgage with us tonight. For let's leave Salma show on the side. We can keep that for repetitions later, or for ¿cómo se llama? Those when you do a lot of reps for a video and then you do the bloopers.
Oh, bloopers. Yeah. Bloopers.
Because bloopers, I did deleted them from my Facebook wall because I found myself saying some things. I was like, welcome, Salma, and thank you for accepting our invitation to talk with us about pre-approvals tonight.
Thank you so much for having me. And like Ainhoa said, I'm Salma Manaa with Fairway Independent Mortgage. I've been in the industry for about 9 years. So I would say I'm pretty well versed in loans and programs and help and getting creative, I think, for our clients to make sure that everybody qualifies, and those who don't, at least we create a path for them to qualify. So that's just what I love to do, and I love my job, and I'm happy to be here to talk about, pre-approvals.
Thank you for accepting the invitation. And I wish I was not in this office, but in your office, so I could see the beautiful view behind. You're making me a little jealous, but that's okay. Maybe we can get ourselves a condo and we can have the same view, right?
Yeah.
Very, very nice place. Congratulations. And well, let's talk about that now that we, have a little less fear of this market or the shock of the rates and the stats of today's market. We can discuss about the pre-approval part. So let's talk about that. Salma, what it is that we need. Let's say we find a great opportunity, especially some of our buyers now finding great opportunities with multi-unit buildings and getting them into investing and having tenants or those renters paid for the mortgage will help quite a lot with that. Or they're looking into house hacking or Airbnb, and they're actually making their money work and not being afraid of this market. Now that we have this type of content or this opportunity, we have to be ready, and we have to stay ready for those opportunities when they become available. How do we stay ready? If I want to qualify for a loan, where do I start? What do I need?
So all really good questions. I would like to start with the market that we're in is completely different. Everybody knows it. Everybody saw 2-3%, a year ago, year and a half ago. Now everybody's seeing the 7-8%, and everybody's panicking, using the word recession. I call it the R word because my branch manager always says it's not a recession, it's an adjustment. And that's just the mindset that I'm in now. So I think it's very, very important to be pre-approved so that you're ready to purchase, exactly like you said, Ainhoa, and the steps to getting pre-approved. They're actually a lot more simple than a lot of people make it seem. I always get the question of, hey, how long is it going to take you to pre-approve me? And I'm always like, oh, just give me all your documents and I'll get back to you in 20, by the end of the business day, depending on when documents are given, but 24 hours at least. And everybody's like, really? So it's really, really simple. The basic documents that we request are income, credit, and assets. So for most clients across the board, and I will discuss the different types of people, or the different types of employment, because some people are W-2, some people are self-employed. So the documents we request are your tax returns for the last 2 years, your W-2s for the last 2 years, if you have any, last 30 days of pay stubs. We ask to pull your credit so we can see where you're at credit-wise. And then we ask to see your last 2 months of bank statements to see your assets, where your money is coming from for your down payment. If you don't have that money in the bank right now, are you going to get it from a 401k? Or maybe a family member is going to gift it. Or one of the grants that we have to offer can help you offset your down payment and closing costs. And then once we have all of that information, we're pretty much running it in our system, and I can get a little bit more detailed as far as how we go to qualifying what we look for.
Okay. So if we have all those documents as a salary person, that's great. But how about those who don't have a company that can offer this verification of employment, these W-2s, self-employed? What do we do with somebody that is self-employed?
So for self-employed, we ask for just tax returns. So I actually just closed 2 loans recently, FHA, and I use 1 year of self-employment taxes. You'll hear a lot of lenders say they need 2-year average, which is the absolute norm. So that is definitely the norm. And in a lot of cases, we do need to use a 2-year average. But in a case where you have just been self-employed for 1 year, case by case, we can definitely review it and get you approved. But for self-employed, we ask for tax returns. We want to see how much you're making. We ask for credit, for us to pull your credit, which is very similar to a W-2 employee. And then we ask for bank statements to see your assets. So really the only thing we're not asking for is W-2s and pay stubs. The one thing I do want to point out with self-employed borrowers is when we review their taxes, we need to review how much they've made after expenses. So a lot of people I notice come to me and they're like, hey, I made, say 80,000 last year. I'm self-employed. I'm a contractor, or I'm a painter, or something like that. Then you review their taxes, and after all their expenses, they really made 20. So that's very, very important. We really need to see what the expenses are for self-employed, because with self-employed borrowers, they're getting paid cash, checks, stuff like that throughout the whole year. And then at the end of the year, they file it, deduct whatever expenses they have, versus W-2 employee, what you make is what Uncle Sam's always going to see what you're going to make. So that is a difference between a self-employed and a W-2 employee.
Okay, I know that you mentioned grants that we may be able to offer. Let's dive on that. Like for somebody that has the credit, has the job history, but how about we are a little bit low in assets? What do we do there, and what are some of the grants available in today's market?
Okay, so there's a few different grants. One, and I think this is the main one that we're seeing often, it's the IDA program. So it's an Illinois grant, and it's given, there's 3 types of them, and I'll just briefly go through them because there's a lot more into it. But one is forgivable, one is deferred, and one is repayable. So the forgivable one, there's actually 2 of them, and one of them is very attractive because of the interest rates. So you can get up to $6,000 in a grant money for one of the programs. And then the other program, which is similar, 4% or up to 6,000 in a grant. But the one that you get 6,000 in a grant for actually has super competitive rates. If I remember correctly, today, FHA was at 6.125 and conventional was at 6.5, which is a little over 1% of what we're giving on regular FHA and conventional loans. So if you qualify for a program like this, you're getting $6K and you're getting a lower interest rate. There are stipulations, so you have to live in the home for a certain amount of times, things like that. And we can always go into detail if you want more information. But that's one of the programs. The other one's deferred and repayable. Deferred meaning you do have to pay it back, but not until the end of your loan, and that's $7,500 in a grant, and that so you have to pay it back. So it's not, I mean, kind of a grant. And then the repayable, it's 10% up to 10K, so max is $10,000. But that one they'll have you on a payment plan monthly, no interest though, which is also a really good idea if you're not, opposed to. If you borrow from mom or dad, you're still gonna have to pay them back. So you pay interest-free money on that one as well. There's another one, it's conventional. It's called Borrow Smart. Not a lot of banks offer it. They only partnered up with certain banks and we're one of them. And this is actually a conventional grant that they can get up to $10,000 depending on the property they're purchasing and their income limits and requirements. But that's also a really good program. Actually, we used it on one of our clients. So she got 8750. So
Wow. Okay.
Yeah. There's a few of other ones. There's Will County up to 25,000. A few, there's the Joliet ones, there's Keene ones. So it depends on the area and depends on the requirements, but there's plenty of grants that are available and that are being used right now.
So this is wonderful information, actually. So if I'm understanding this correctly, now more than ever, using grants works on your favor because of the interest rate being lower too. And I mean, at the end of the day, you're already borrowing money. So if it works for you and you do qualify for it, not a bad idea to explore that option at all.
Absolutely. Yeah, they're very, very competitive with their rates. The other programs with IDA, they're similar in rates today. So that one program is the one that's lower. They're very similar to our grants, but they're at no charge. When right now you're frequently seeing borrowers having to pay for an interest rate. With IDA, it's just a standard rate, and you just get that rate and you don't have to pay for it.
That brings a question. How about refinancing when you do have IDA? Is it a problem at all? Like, let's say next year, at the end of 2023 or 2024, is still within the time frame that you're supposed to live on the property to still, qualify for the IDA? Can you refinance?
So good question. The ones that are forgiven, if you do refinance within 5 to 10 years, depending on the program, if you refinance or sell your home, you do have to pay the grant back. So they want you at least in the home for 5 years. However, let's say rates go down like dramatically in 3 years, right? And I'm giving a scenario. So you're going from a 6.1 and rates are at 2%. And you're like, there's no way I'm gonna let that go, right? What they will do is they will charge you for the remaining 2 years that you did not live in the property. So if they gave you a 6K grant for 5 years, they're going to prorate it into a year, every year, how much you owe back. And then if you don't live in the home for the 2 out of the 5 years, then they're charging you only for those 2 years. So you still got free money somehow.
That's right. And as you said it, like if the rate it is at 2% for the life of the loan, it makes more sense saving wise than having to pay $2,000 back.
Exactly.
So in the end, it's about understanding your loan product and understanding what you're supposed to do from the very get-go, what the small little letters are in every single thing.
Absolutely.
Just being very prepared.
Mhm.
Wonderful. How about types of loans? Those are grants that we just said that they can be added into loans. I know you mentioned already FHA and conventional, but let's go a little bit more into details on this. How many type of loans are available and that Fairway actually does provide? And what are some of those requirements?
Okay. So the FHA's conventionals, those are very basic. We are very well versed in VA loans. So VA loans are for any, veterans who are looking to purchase a home. We do 203Ks, which I know a lot of banks discontinued during COVID and never got it back. And a 203K is basically a renovation loan. So 203K is FHA, and then renovation and a rehab loan is conventional. So I don't like to, confuse the words together, but overall it's a renovation loan. And what that means is you buy a home, you buy it FHA 3.5%, and then you get the renovation or the repairs or the cost that you want to make into your home, and you add it into that mortgage. And so you're paying on one mortgage of your purchase price and any kind of renovation cost that you have. It's all one lump sum, one mortgage payment, no crazy interest rates. It's like a regular FHA loan. And you make all the cool adjustments and everything depending on what you qualify for to your home. So that's also a really good idea. We do DACA loans, of course. So for all my DACA recipients, we do loans for them as well. And IDA does apply to DACA. So if you have DACA, you would be eligible for the grant. What else? What else do I do? I'm trying to think. Can you think of another loan that I missed? I feel like that's it, right?
Well, if you want to just touch on the conventions, I know some people think a lot when we meet for the first time or we discuss real estate for the first time. They think that conventional means 20% down.
Mhm.
And within conventional, there are many different type of down payments. And if you want to tap on that and what the minimum required credit score would be.
Yeah. So for conventional, you can put as little as 3% down. So it's anywhere between 3 to 5, depending on your credit score. So the higher your credit score, the better, or the lower your down payment. Credit score requirements for conventional, it's a little open-ended. The only reason is because if we were to look at the black and white guidelines, it says a 620. Is it possible to go through the 620? Yes. But have I seen it throughout my entire career happen often? No. So I would say comfortably like that 660, 670 range for a conventional loan. That would increase your chances on qualifying for one. Now FHA, on the other hand, that's 3.5% down. And we do as low as a credit score of 580. So we're not even at the 600. So we're at 580 for FHA. 3.5% down, and it would just be a regular 30-year fix for both. We have options if you want to do 15 or 20 if you want to get creative. But as far as the VA loan goes, now that's a different type of program. So we can do as low as 0% down on a VA loan. And the perks of VA loan are actually honestly outstanding. So if you have any kind of VA benefits, use them, take advantage of them because they're definitely great. 0% down, and you have no private mortgage insurance. So you will not be paying mortgage insurance as part of your payment. So not only do you bring essentially nothing to the table if you have a great team that can negotiate extra credits for you, but at the end of the day, your mortgage payment isn't even going to be as high as a regular loan would be because of that mortgage insurance. So that's definitely a good program to get if you qualify.
I actually have a question on the realtor side for VA.
Okay.
I know that for VA, one of the requirements when you are under contract is to perform a termite inspection. And usually it is paid by the seller. Could you confirm this? Or is because I've heard when we talk with a different agent and we let them know that the seller was going to pay for that, she said, oh, absolutely not. My seller's not going to pay for that inspection. And I ended up paying for it myself because I wanted to make it happen and the client was very happy. But usually that's paid by the seller.
So a lot of A lot of people don't know that, but you are correct. It does have to be paid by the sellers. There is certain states that allow the buyer to pay for a termite for a termite inspection, but Illinois is not one of them. So it would have to be paid by sellers.
Okay. Well, at that time it was not paid by the seller, it was paid by.
Well, so hey, and that's the perks of having such a great team. You guys are just so professional and you guys make things happen. But
Yeah,
you know what? At the end of the day, we have to do what we have to do, right?
correct. But I also don't want to sound like, we pay for your inspections. It was an exception because we were very, very far in the process, and the buyer was not supposed to pay for that, and it was that or cancellation. So at that time, the market, they had 17 other offers waiting. We didn't want to go through. So at that time was like, I'm not going to put the client through having to even discuss that, or having to go back and look for homes or anything. And I'm like, no, we'll just take care of this outside. So that's why we did it. And we are resourceful and we usually find solutions for every single scenario that happens. I mean, that we've
For
done
sure.
it. We find ways, and we get creative. You include it as well. So we get creative. But before we finish this conversation, I wanted to tap on the do's and the don'ts for when you're actually pre-approved. Now that we have a pre-approval letter, now that we already know that have an active job, that we are making money, we can repay this loan, we have a credit that allows us to purchase a property, we have the assets or the grants available that we were able to secure. Now that we're pre-approved and ready to shop, what are the things that our borrowers or buyers should avoid doing while shopping for a home and while under contract until closing date?
Okay. Good question. At one point in my career, and I think this was when it was like the 13 offers per house season, so about a year ago actually, or maybe a few months ago, we started creating a list of do's and don'ts that we sent as soon as we got a contract. And actually, as soon as we got a pre-approval, but then we did it again as soon as we got a contract, because we've seen it so often, and we were like, oh my God, like this is, we find a way, but it's still difficult. Do not change jobs. And if you do change jobs, let me know. That's important. Do not buy anything or open up new credit cards, or honestly, just don't buy anything throughout the process. I always tell my clients, I know you have to live, but if it's not like a literal living expense, please call me. Like I had a friend or a client that called me to ask me if she could spend money for her birthday. So that's how deep we are. Don't open up new credit cards, because we'll find out. A lot of people don't think that we'll find out, but we will. Don't deposit cash in your bank account. Any kind of cash that you have at home that you got for your birthday, that your grandma gave you, do not deposit. Any cash deposits need to be sourced, and if they are not sourced, we can't use it. So you can have $20,000 in a bank account, and to us it will look like you have zero because we can't use it if it's cash. Or unless you can source it, because a lot of people are like, your painters, your contractors, my self-employed clients, I mean, you get paid cash, that's documentable, right? Because you're self-employed. Let me see, or not cash, I mean checks, whatever, both, a mix of both. What else have I seen that was super crazy? Cash. Can you think of something?
Yeah, but it's in line with the purchases.
Okay.
We did have a client that we were kind of like getting, I don't know if we already got the clear to close and we were about to. That means that your loan is fully approved, but we were kind of like right there. And she called me on a Saturday morning from the furniture store. And she said, I am about to put a deposit down. I already picked up my living room, the couch and all of these things. And she's like, something told me to reach out. And I'm like, do not do anything and leave the store this second.
Get out there.
Things into your wish list and have an idea of what you want and all of that, but do not open any credit accounts on anything.
Right.
Especially with people that they have the ratios tight, or that they're barely making it to get their pre-approval and they work so hard to do it. it could be so close of losing it all. So yeah, any financial decision needs to be run by your loan officer, in this case, Salma, to make sure that, hey, this works, this doesn't, please wait on this. Do not co-sign for cars.
Do not
Um,
co-sign for your for your mom, for your
oh
sister,
my
for your
God.
girlfriend. Please don't.
That
Don't.
it happened. It happened to us,
I've
and
seen.
mine ended up not even purchasing a home yet because it was severe. They had an accident over the weekend, well, the week before, but the niece was in town, needed to go to college, needed to get transferred to Urbana, I'm sorry, the south of Illinois, and the uncle was the person that was purchasing with us. And he was like, I just had to, who has the better credit, who has some assets, who, and they were just helping. You know how we are, we help our families. And that was his justification. We had a car accident, she needed a new vehicle, and that, he signed for her. And that was another $540 per a month or something like that, completely through his purchasing power. And at this time we had to cancel. We just got an accepted offer, so we couldn't go any further. And at
Oh,
the time, he's still in the payment, so we keep in touch and everything for whenever time allows to go back. But unless you're getting another job that can secure that additional income, your debt to income ratio will just not work. So
I actually have something to comment on that. A lot of people have come to me, hey, I co-signed for my parents on their house. Can I buy my own? Hey, I co-signed for my girlfriend for a car. Can I qualify without it? The answer is honestly, yes, there's a chance. So with mortgages and with cars, if you have another person on the mortgage with you, or if we can prove that that person has been making payments consistently 12 months out of their own bank account. So it cannot be you and your wife on a bank account and your wife is paying out of your joint bank account. It has to be separated. If it's 12 months, we can omit that from hitting your debt, basically. So when we're calculating your debt, we would not calculate that we've proven that we have 12 months of, hey, this is being paid by so-and-so. And now the bank has more like an idea of, all right, 12 months, a year, they've been paying it. So we feel comfortable to omit it. So that is also a very common question I've been receiving.
that's a great point that you mentioned that. Yes, we get that question all the time, especially with the communities that we serve a lot. They tend to, to help one another, and we run into this a lot. So very good point. That brought me another question that probably somebody can take advantage of as well. When we have somebody that tells us that they have been neglecting their student loans, if they don't have a payment plan for it, or if they do have a payment plan, can you give us some light on how can they potentially qualify for a loan for an FHA loan if they are neglecting a federal loan already?
Okay, so this is a really good question, and I've had this happen more time than I would like to admit. But basically, if your student loans are in default, no government loan will give you another government loan. So basically, FHA is backed by government. So it's a government loan. So if they see your student loans are defaulted, meaning they're in collections, you didn't address it, they're not deferred is completely different. So if you just were making payments and then one day you didn't, and they're in collections, you didn't do anything with them, you do not qualify for an FHA loan until that is out of default status, and they are even making you wait a few months to prove that you're going to be making those payments. So it's really, really important that if you have student loans that are neglected, that you get on some kind of payment plan, or prove that you can't pay it right now, or prove that you're in school and they're deferred. Take care of your student loans. They're huge, and they make a huge difference on your credit. That would be my number one tip. Conventional, if you neglected your student loans and you want to go conventional, they don't really care about it. What we will do though is we will take a certain percentage depending on what program that you qualify for. So if your student loans are deferred, we will still need to take a percentage depending on the program that you are qualified for. If you're on income-based, depending on the program you qualified for, we can use it. If you have a payment, then great, you have a payment, and that's what we use.
Very, very good question. Somebody told me before about this, that if you didn't have a payment plan in place, they would allocate from your debt to income ratio. They would allocate $250 that you're paying that loan. Like,
So it would be a percentage. No, so there isn't a set number across the board. So it's a percentage. It's either 0.5% of the balance or 1% of the balance, depending on the program. So if you owe $100,000 in student loans, then we're taking 1% or 0.5% respectively, depending on the program.
Got it. Okay, very good clarification. Thank you. I mean, I think that's it's for today. Today we just want to talk about that pre-approval, and I think you gave us some great information on what is needed for you to get pre-approved, what the differences are between self-employed and somebody that is employed by a different company. We'll also talk about the grants in case somebody's needing some assets in there, and the benefits actually of today's grants, because we have lower interest rates for them. And also to do some of the don'ts, what to do to prevent you from failing your pre-approval and not being too close on a home. So I think overall we touch base on many things on the pre-approval part, including also the type of loan. So I think this will be a great summary for somebody that wants to get their feet wet and understand what it takes to get pre-approved and what types of loans they are. So thank you for your time, Salma. I think 1,050, you will say 1,057 take?
A lot of attempts. And off of what you said, if I can just give a minute of advice, I think a lot of people right now are panicking because of the market we're in, because of the interest rates that we're in. But I think this is such a big opportunity to take advantage of where we are in the market. Home values are not dropping. I know a lot of people are saying, hey, I'll wait a few months until the home value drops. Home values are not dropping, and everybody sees it. Are sellers dropping their price? Yes, maybe a little bit so that they can work with the buyers that are in the market right now, especially with interest rates. That's just an adjustment. But home values themselves are not dropping. I have probably, I would say, I closed over 100 deals this year, and maybe 3 of them or 4 of them, and I can even go back and prove this, underappraised. And it was because everybody knew that they were going to underappraise. So my opinion is, it's a market. You could take advantage of it with the right team. Like, Ainhoa's team, they're very professional and they're very dedicated to making sure that they meet every what is that word? They just want to meet all the needs of their clients, and they want to take care of you from A to Z. But the most important thing is, don't let the interest rates scare you, because it's not forever. Don't let the media scare you about a recession. Don't let the media scare you about your home value, buying your house and then your home value dropping in a few months. Knock on wood, but I'm not predicting anything, but from what we're seeing and the numbers and the statistics, it's just doesn't look like it's not gonna be the case. Take advantage. There's a lot of options. The supply is still low. I mean, Ainhoa, you can even comment on that. Supply is low. Yes. Demand is still high. And when you see that, a market doesn't just crash.
Correct. We have now, more than ever, we have the largest amount of 35 years old in America. Mm-hmm. So consider 34, the prime age for purchasing. We actually have a lot of other young folks that they buy at their 20s and even like 19 years old. Mm-hmm. But we have the largest amount of buyers in that prime age to purchase, that they have the funds to do so, the employment to do so, and the credit scores to do so. So, and we don't have enough inventory. Right. So, I do like the idea or the word that you've said, adjustment. This is exactly what we tell our clients all the time. This is an adjustment that was very much needed. In 2020, the properties went up in value 32% by the end of the year. That is extremely unhealthy for our economy. Extremely unhealthy. Good number year after year. Home value raising is 3 to 5%. So 32% was extremely high, and that was going to bring some consequences. At that time, Feds decided that was the Feds that gets going, decided to do that, to accelerate or motivate the economy because of the pandemic. But with incentives and having the interest rates low, that also brought even more buyers to the picture, and that drove the multiple offer situation, the overpaying on properties. It was an absolutely quote unquote nightmare for many. And some of them left the market. They couldn't stay with not getting their offers accepted. And on our team, we got many offers accepted, and we had amazing 2 years, and our clients enjoy their homes. But we did make sure that they did not make a decision just on the fly, but also some other stats that they were shared with us about a couple of weeks ago, is that about 80%, and they say an amazing stat, or amazing and scary, 80% of the people that they purchased from 2020 to 2022 during these rates, they were extremely happy with their monthly payment, but they were not 100% content with their home. They were not. They maybe waive inspections, and they found there was an issue afterwards that was going to cost them money. Maybe they compromise on location, or they compromise on what was actually a deal breaker to them. They compromised because it was just like, go, next, go. Submit another offer, submit another offer. So they weren't fully 100%. 80% is a big number. 18% wish they didn't do it. So 18% is still a big number, but overall 80% of people, and this is by NAR, National Association of Realtors, that the stats say that they're just not fully content with their home.
Exactly. Yeah.
So
that was actually a really good point. That's really good.
Yeah, no, we were and this is kind of like part of what we discussed last week on the other episode on what's today's market, the pros and the cons, and what we are seeing in the marketplace. And the only con is the rates. We understand that, but there are many benefits of buying in this market, many, with those being credits. And if you understand your loan, and maybe we can leave it in this note, if we have planted any seed on someone, or they have the desire to start investing, or to become a homeowner for the first time, stop renting, to become an investor, multi-unit, Airbnb, all of these opportunities that they are out there to make money and create wealth for yourself, why are you too concerned about the percentage of the rate? If you are comfortable with your monthly payment, that's what it matters. If you can afford your monthly payment, you're paying $2,000 in rent. How about I find you a place that you pay $2,000 but it's yours? 100%. Doesn't matter what the rate says. That rate is going to change. But if you are comfortable with your monthly payment today, and you understand your loan product, we can get you into a home sooner rather than later. You don't have to battle with 17 offers. That was last year, July, 17 offers per home. It was waive inspections, go 30, 40, 50,000 over. That's the same difference in getting a higher interest rate. Or largest, or larger. Because that amount, if you pay 15, 20, 30,000 over, how many years, break it down, how many years are you going to have to stick to that higher rate to actually overpay $50,000 now? How many years? By then you already have refinance. So really understanding the numbers, and more than anything, being comfortable with your monthly payment, forget about the rest. You have your own goals. You want to make it happen. And that's kind of like what I said at the very beginning of this call, is we need to give the tools to our communities. That's what it is. Because every single recession, adjustment of the market and the economy, our communities, Black and brown, are the ones that they get the hurt the most. So giving them the resources, that's all we're here for. So thank you for joining us tonight, Salma. It's always a pleasure. I love doing things with you. And if, like Ainhoa said, if you're on the fence, talk to us. Let's see what we can do for you. Yes. Thank you, darling. I will stop the video here and then share with everybody. Okay. Thank you. Have a wonderful night. You too. Bye.